So let's get to the crux of how this works. I'm going to ask you to hear me out on this because I'll admit it, it's a different way of thinking about your retirement. This retirement plan is based on a life insurance product called an Indexed Universal Life Contract, or I.U.L for short. Now, don't jump to any conclusions as to the stereotypical thoughts of what an I.U.L is. This is different than any whole life, variable life, or universal life plan you may have purchased in the past. This I.U.L is a lot more about a savings plan than it is about a life insurance plan, even though it does a nice job of providing you that too. Not only are there tax advantages and principal protection advantages, you also need to know that the I.U.L, when structured and funded properly, will knock the socks off of any retirement savings plan in any comparison category, including growth potential, risk avoidance, liquidity of funds, flexibility of contributions, flexibility of distributions, longevity of distributions, and fees. Life insurance companies, by law and by track record, are extraordinarily conservative. Life insurance companies that offer I.U.L, as a rule, have tremendous cash reserves. One company, for example, had operating revenues in 2008, the worst year of the recession, of $14 billion, earnings of $1.3 billion, and cash reserves at the end of the year of $12.8 billion. Their stodgy ideology is also part of the reason you've never heard of an I.U.L before. Life insurance companies thrive on risk management, actuarial tables, and other boring life insurance stuff. But they aren't so great when it comes to communications. Go online now and read their brochures. It's dull, vague, and confusing, just trying to figure out how to find the information you're looking for. But that doesn't mean that Indexed Universal Life product isn't a valuable tool for creating wealth. The I.U.L, Indexed Universal Life, is indexed to the S&P 500, which simply means that it mirrors the growth of the S&P 500, which, for your information, has returned over a 9% of average for the last 27 years, and that includes the 1980s and right after 9/11 and 2008. But here's the best part. The I.U.L accounts never lose principal or growth. The reason I.U.L accounts won't lose principal when structured properly is because the lowest return guaranteed by the contract is 0%. In other words, they have a floor return of 0%. They can't go into the negative digits. If the stock market tanks for the year, your I.U.L contract doesn't take a big hit. It stays even, right where it is. An I.U.L participates in the gains during up years, but it doesn't participate in losses during the down years. Can those deferred accounts come close to competing with that? From experience, most folks know that portfolio losses are killers because you have to double up just to get back to even. That risk is eliminated with the I.U.L since your floor is a 0% annual growth. No loss of principal or gain. Just think how that compares to the devastating 37.2% loss of the S&P 500 in 2008. Take, for example, if you were indexing your IRA with the S&P in 2008, and if you had a $1 million portfolio on January 1st of 2008, you would have ended that year with just over $628,000. Even with the big bounce back of 2009, where the S&P returned 23.6%, the $628,000 you had left after 2008 would have only grown to about $775,000. You're still down from where you started by $225,000, but not with the I.U.L. Now, there is one other catch of the I.U.L. While it does offer the peace of mind of the protective 0% floor, it does also cap the gains on the upside. That means that when the market has a huge growth year, your investments will be capped somewhere in the 12 to 15% range, depending on the carrier and the contract. Keep listening, and you'll see this is not a big issue. In fact, it's quite the opposite. Here's why. Remember, huge gain years almost always follow huge loss years. 2003, for instance, was a great 26.3% gain in the S&P 500, but it followed 3 consecutive years of negative returns. 2000 down 12.2%, 2001 down 13.4%, and 2002 down 21%. Let's run those numbers. If you had $1 million in your IRA January 1st, 2000, it would have fallen approximately to $878,000 the end of the first year. then continued to fall to just over $760,000 at the end of 2001, and then plummeted to a measly $577,000 at the end of 2002. That same $1 million in a loss-protected I.U.L. would have retained its value at the end of 2000, even though the market was down. Still worth $1 million at the end of 2001. And guess what? Still worth $1 million at the end of 2002, even though the market got slaughtered. That's 3 consecutive down years and $423,000 in avoided losses. Wow. Then it's 2003, let's say, and you were in the I.U.L. carrier that had the 13% cap. Remember the big downside catch? It has a cap. Your $1 million would have grown to $1.13 million. It grew. Meanwhile, the qualified plan portfolio that tanked from the $1 million down to just over $577,000, it would have gotten the full benefit of the 26.3% market gain, not a 13% cap like the I.U.L. contract. But let me ask you, would you rather add 13% to $1 million or 26% to $577,000? 26% added to $577,000 only brings the account to about $728,000. And compared to $1.13 million, that's a no-brainer. At the end of a 4-year cycle, you would have been ahead by $400,000 with the I.U.L. This is real money in a worst-case scenario. The only way a qualified plan could possibly do better is if the S&P were to go up unfettered by over 15% per year for 5, 10 consecutive year periods with 0 negative years. Do you really think that's going to happen? And even in the 1 in 1 million chance that it did, get ready to pay the tax man when you retire. I know these numbers can start to be a bit mind-boggling, but they're so critical for you to understand so you can see how to avoid becoming financially devastated when you retire. Let's continue with the example just a little bit further. We stopped our example at the end of 2003, where the I.U.L. account that started with $1 million had grown to $1.13 million in spite of the negative years. The IRA account was down to $728,000, but only after a really strong 2003. Now, let's look at what happened in 2004 through 2007. The S&P gained 7.2% in 04, 1.2% in 05, 12.8% in 06, and 1.2% in 2007. Your I.U.L. account, since it's indexed to the S&P 500 and since all the gains were between the 0 floor and 13% cap, your I.U.L. would have received all of those gains, 7.2%, 1.2%, 12.8%, and 1.2%. At the end of 2007, your $1.13 million account would have been up to about $1.4 million. So when the S&P had the 37% loss in 2008, the I.U.L. account would have stayed at $1.4 million, no loss. So where would the tax-deferred account be? It would have grown from about $728,000 to $900,000 during those same 4 good years, still down by $100,000 since 2000. At the end of 2008, it would have been back to $565,000. If this was your scenario, where would you rather be at the end of 2009? $565,000 or $1.4 million? This isn't a retirement savings vehicle for the ultra-conservative. This is a retirement savings plan for those who can think outside of the box of traditionalism. If you think market caps of 12 to 15% are a poor trade-off for a contractual guarantee for a 0% floor, then this plan is not for you. Of course, we don't have a crystal ball to predict what will happen in the future, but I think we can agree it's safe to say the market is going to have up years and down years. Protecting yourself and your family from huge losses is one of the primary advantages of the I.U.L. As you can see from our example, there is safety in the I.U.L. that is not in index-deferred plans. Okay, we've covered the tax advantages. I think they're pretty clear. The risk avoidance issue is highly important, and it favors the I.U.L. by leaps and bounds. But also remember, indexed universal life is also life insurance. When you die, Whether the day after you fund an I.U.L policy or years down the road, your heirs will receive a death benefit tax-free. Of course, the amount of benefit will depend on the size and structure of your policy. But how much do qualified plans and brokerage accounts pay in death benefits when you die? That's right, nothing, because they're not life insurance accounts. Do you see what I mean when I say this is the best retirement vehicle you've never heard of? There's another reason you probably have never heard of an I.U.L before. Besides the lack of communication skills of these old insurance companies, the bigger reason is financial advisors almost never talk about I.U.Ls. That's because only licensed insurance agents can legally sell you an I.U.L, and most licensed financial planners, money managers, or brokers, they're not licensed to sell insurance. So the person who sells you an IRA cannot, by law, sell you an indexed universal life policy. And if he can't sell it, he can't make any money on it. So why tell you about it? Financial planners' motivations is to get you signed up for an IRA or 401k and then to make money on you as your investment grows for the rest of your life. I'm sure many of them don't know about I.U.Ls themselves. Try this. Call your financial advisor and ask about an I.U.L. Chances are 99 to 1 that he or she has never heard of it. Why would they know? They don't sell insurance products. They like to think they have the only answers to helping save for retirement, but they don't. And they don't even realize it themselves. Just one more quick thing, and then we'll let you discuss the fine points of an individualized plan for your situation with your team member who is a licensed insurance professional. This is a high-level view of how the I.U.L works. As with any life insurance policy, you make monthly or annual contributions into your account. You will work with your team member to determine what the optimal amount is for your situation. The plan is individualized based on how many years you have left until you want to retire, your financial goals for retirement, and your current financial situation. The money you contribute to an I.U.L, like we've discussed, will continue to grow tax-free. Unlike qualified or deferred accounts, you may have access to your money anytime you want or need it without penalty, before or after you retire. When you pass away, the balance of your account will be passed on, just like any other life insurance policy, to your heirs tax-free. If this makes sense to you and you want to explore an individualized tax savings plan, give the person who gave you this video a call or discuss your particular situation. He or she will be happy to answer any questions you may have.